Welcome, everyone. We'll be starting momentarily after attendees have a chance to enter the webinar. Looks like we have people starting to enter, Brian, but why don't we get started?
Okay.
Well, thank you for joining us for our live presentation, or to those who are watching on our recorded webinar. I'm Chris Boyd, and I'm joined today by Brian Regan, AMR's Chief Investment Officer. In this webinar, we'll be reviewing what has been happening in the economy and the markets and the outlook for the near future. We'll be recording the webinar. Your participation implies consent. You will have the opportunity to ask questions either through a Q&A feature or the chat function. At the end, if you would like to ask a question verbally, you'll have the opportunity to raise your hand and we can unmute your line. On a compliance note, please be sure to see the detailed page of citations and disclosures at the end of the presentation. But in the meantime, know that opinions are subject to change and information has been derived from sources thought to be reliable. The webinar will be posted on our website and YouTube channel later today, should you want to go back and review any of the comments, or if you'd like to share it. Because things are continually changing, we encourage you to listen to our podcast and radio show, Something More with Chris Boyd, for our most current thinking from week to week. Additionally, remember that you are welcome to call or to arrange a meeting with us, particularly if you think your circumstances or needs have changed, or if you'd like to go over something on a one-on-one setting regarding your portfolio or your plan. As part of today's presentation, Brian will take us through a review of some of the changes we have faced over the recent past, what actions we at AMR have taken for our discretionary client accounts thematically, and how that has fared. We'll be looking at where that leaves us now, how we've been positioned recently, and how those decisions were made and results. Finally, Brian will be looking ahead, identifying current opportunities in the current climate we're in, and valuations as well. So how those insights will lead into the themes and adjustments we're planning for client accounts. Again, if you have questions, don't hesitate to add them through the Q&A feature, and we'll be sure to incorporate them either at the time or at the end of the presentation. I want to mention additionally that in addition to our quarterly webinars on portfolio and economic and market outlook conditions, we do have a financial planning webinar each quarter. This quarter will be, the topic is the retirement red zone. And we'll be having that on September 20th at 10 a.m. Registration can be begun through our website on the webinars page, and we will email you as we get closer to the event, the link and so forth. With that, that gets us ready to jump right in. Brian, take it away.
Thanks, Chris. So before we get into the details here of 2023, let's talk about what overall has happened. The market has stormed back, particularly the NASDAQ, close to 40% now. The next slide that I'm going to show shows quarter end. It was about 30% up then, with the Dow lagging a little bit. This is a kind of a mirror image to what happened in 2022. So my investor insights letter this quarter was all about exaggerated narratives or false narratives that happen in markets, and it's fairly common. And what I think we saw in 2022 was an exaggerated narrative around inflation. Inflation certainly got pretty high in June. but then it peaked and it started to fall fairly dramatically. And as the market reacted to that higher inflation, it took a little bit of time to react to the falling inflation, which we're certainly in now. And in 2023, the market has responded fiercely with the falling inflation, and that's a lot of what this presentation is about. We're going to talk about how the inflation narrative happened, how the inflation mania happened, how some of it was very justifiable, and how we addressed it. And then we're going to talk about how it broke, and how we positioned for the expected breaking. We always kind of thought that this was going to be a 2.5 year period following the pandemic. But what we didn't know was when the market was going to start to price those facts in. Now we know it started about October 12th, 2022 is when it started to fully price it in. I think it really started actually in June, though, as inflation peaked. There was some British bond issues that drove an additional sell-off through October. But it seems to be right now that we've bottomed October, at least here in the short run. And it's really about this inflation story that we're going to get into. So the first thing I'm going to do is let's take a look at some of these gaudy numbers. They're much better now. Like I said, this was pulled at the end of the quarter because it's a quarterly webinar. 30% in the NASDAQ, it's close to 40 now. 15% for the S&P 500, closer to 20 now. But you can see that the bond, even the bond aggregate, started a nice recovery again. 2.32% at the end of the quarter. That's only halfway through the year, so that's on par with kind of the average yield to maturity that we've expected in bonds, which is reasonable. So it's just been a great 2023 so far for risk assets. So let's talk about the inflation mania. What happened in 2022? Why was there the mania? I'm sure it's all still fresh in a lot of our minds. We've talked about it on previous webinars, so I'm going to go through this relatively quickly. The reason why I'm choosing to go through it at all is because I want to be able to show the flip side. How are the things that did happen with inflation mania reverse themselves to the point where we're at this place now where we actually have fairly low inflation? So here's the inflation chart that we could see at the top. On the bottom, you can see that's where the target Fed funds rate is. You can see that the PPI reached a high of 11.66%, the CPI reached 9.06%, and core CPI reached 6.63%. Today, again, this chart's about a month old. The CPI inflation rate is 3%, with core a little bit higher than that. The Fed's target is for PCE, which typically runs on average about 30 basis points lower than the CPI, to be 2%. So we're very close to the target. If you adjust for things like rent, which are coming down in real-time terms, but not in year-over-year terms quite yet, inflation is not an issue any longer as far as the Federal Reserve is concerned. A good question. Chris posed this question to me yesterday, is why is core inflation higher than regular inflation? There's really two reasons. One is that the biggest part of core inflation is rent, or owner's equivalent rent, that reacts on a lag. That's expected to continue to come down throughout the rest of 2023 and into early 2024. And the second part is the regular CPI has food and energy in it. And we're going to see in later charts what happened with energy over the last year. So we had a surge in government spending during the pandemic. We've talked about this before. The initial one was the CARES Act. This was a big bill, multi-trillions of dollars, to get us out of the deflationary spiral that was inevitable as we shut down the pandemic. We had a second one that Trump also signed in the omnibus budget plan, which really started to kick up inflation. And then finally, we had one final one, the American Rescue Act that Joe Biden signed. And I think all of that helps contribute to, Lisa lines up time very, very interestingly by time with the increases in the CPI. At the same time, we had very loose monetary policy. We had zero interest rates all throughout this time. So we were getting this massive amount of fiscal policy. We had zero interest rates into 2022. Not only that, we were still buying bonds, particularly in the mortgage market. So we all know what happened with home prices during that time. And this all contributed to it. A big cause has been labor. So the labor force didn't come back again until early 2022. These are all kind of pandemic issues. We could see that the unemployment cratered. This is the U.S. employed persons, and that led to higher wages, and higher wages led to more inflation. You can see the war, the cause of the war. So the Russians invaded Ukraine. There was a series of reactions to that, but a big one was a lot of the world's oil was coming off the market or expected to come off the market. Actually found its way into China and India and a bunch of other countries. And at the same time, the United States started pumping more, started pushing liquefied natural gas through shipping channels. China started back channeling liquefied natural gas that they were receiving back through into Europe. And all this kind of corrected itself over in time. This is kind of, the miracle of capitalism, right? High prices end up curing high prices. So we could see that initially we had this big increase in in crude oil, which helped push non-core inflation, regular CPI, to those June highs. And finally, when we walked down, everybody got goods, and we weren't allowed to travel. We weren't allowed to go out to restaurants. We weren't allowed to enjoy our favorite services. So we saw this big flip. We had supply chain issues that had a lasting impact. So far, this has kind of flipped back. So there's, again, another one of the things that we saw that happened, which have kind of, changed in time. But as inflation rose, interest rates rose, as we see with the blue line, which is what I'm most concerned with when it comes to stocks, it's long-term treasuries, 10-year treasuries. As that rose from, January of 2022 down, around 1.5% to over 4%, the S&P 500, reacted negatively. And we saw a giant sell-off through 2022. So how do we position for all that? Well, we kind of have to position the portfolio two ways, and we call this a barbell. The way I'm describing it is one side of the barbell, we call it a limiting pain portfolio. And we understand that inflation's high. We can't do anything not to be defensive against it. We have to be defensive against that fact. And this is the portfolio there. On the other side of the barbell is we understood that inflation was likely going to break at some point, and we had to be positioned there as well. So we had this really interesting portfolio where, we were really playing both sides of the boat. And, that led to a good amount of diversification, which, what I believe helped us limit some pain in 2022, but it's also helped us keep up with the rally here in 2023. So what do we do to limit pain? So this is the barbell as I was talking about. We're talking about the fixed income portfolio here. As interest rates rise, you want to be in short-term bonds. So why do you want to be in short-term bonds? Because you're going to get paid more as the short-term interest rate gets risen by the Federal Reserve. But you're also not going to be hurt with rising longer-term interest rates. So that's why you might have noticed in your portfolios that we emphasized JPST, which is a JP Morgan ultra short investment grade bond, USSBX, similarly a little bit longer than JPST, and CFRAX, which is a floating rate and bank loans credit fund that we were in throughout 2022 and into 2023. So, those were the ways that we were, quote unquote, limiting pain from rising CPI in the bond portfolio. So this is a, graphical representation of this. The orange line shows the CPI. This is CPI straight from the BLS data. As that went up, our target duration, which is the amount of interest rate risk we're taking, went down. We purposely acknowledged that we had this problem with inflation. We better take less interest rate risk. We weren't taking much to begin with. At the very beginning there, we were taking a little bit of shade over 4. The aggregate bond markets is around 6 or 7, but we got as low as two years in duration, which is very low. When it comes to the equity portfolio, what we've seen is really two different markets. Throughout 2022, the Dow Jones, for example, which is more representative of quote unquote value stocks, held up relatively good. It wasn't down 30% like the NASDAQ, 30+%. It wasn't down 20+% like the S&P 500. It was down in single digits. We needed to be positioned to some of those stocks as well. So on the the equity barbell, we had a fixed income barbell, but we also have an equity barbell. The positions that we had that limited pain from the rising CPI was the minimum volatility factor ETF, USMV, the large cap value ETF that you saw in your portfolio. They would be more correlated, similar to the Dow Jones index there, not necessarily as much as the NASDAQ that you saw there. But we were also underweight equity generally. Here's another representation of how we decreased risk. This is beta. This is a chart that shows the relative volatility that you're taking to the market. If you have a beta of 1, you're taking the same volatility as the market. If it's over 1, you're taking a little bit more, hoping for more return. If it's less than 1, you're taking less. So you can see that throughout 2021, we were taking more than 1, and that was good because 2021 was a very good year. But since then, we started dramatically bringing it down through October of 2022. And finally, this is our risk asset index. What I define as a risk asset is either a high yield asset or an equity asset. Excuse me. And we were reducing that most notably in stocks. We were underweight stock basically throughout all of 2022. Now, we always thought, and this was certainly arguable throughout 2022, and but I think that we've said it enough in webinars and radio programming that you can believe me when I say that we always thought that inflation was going to last 2 to 2.5 years, similar to the 1944 or 1946 inflation issue that we've had following World War II, and we had to be positioned in case inflation broke. And as I got closer to the end of 2022, it wasn't necessarily a question whether inflation was breaking. It was when the market was going to realize this. So we had to have the other side of the barbell that took advantage of that. So you can see that the inflation rate fell dramatically, right? I got PPI highlighted there, which is the purchasing price index. Oh, sorry, producer price index, which is just a little more exaggerated version of inflation. That reached a high 12, and now it's at 1. So you can see that over time, all those things that we highlighted before that caused the inflation are really reversed. We're not having $1 trillion bills signed anymore, right? We haven't had one since the first couple of months of the Biden administration. We've had aggressive Fed tightening. 525 basis points in a year and a half is very aggressive. They're slowing down now, though, which is something to keep an eye on. The people came out of the woodwork. There was more people in the labor force than I think a lot of people expected. And what did we see? We saw prime age women came back into the labor force. I believe personally that they had trouble finding childcare. So following the pandemic, so they had to stay at home more. Older people that maybe were considering retirement or felt uneasy about going back into the job market because of COVID or any other reasons, they started coming out of the woodwork. Interestingly enough, we are seeing a lot of retirements, and that would make sense as you see home prices go up, and we had a big increase in the stock market. It would make people more comfortable doing things like that. But have we seen the labor market normalize? We've also seen wages normalize, which is going to put downward pressure on inflation. High prices cure high prices. I mentioned this earlier. Rig counts, which is the amount of rigs drilling oil in the ground, are near pre-pandemic highs. And oil has found its way around the world to the places that it needs to go. And the prices have come down to pre-pandemic, normal prices. The bottom here, I have gas prices, retail gas prices, and on top I have crude oil. You see the charts look very similar. One kind of informs the other. Crude prices, I think inform about 40% of retail gas prices. So we saw some of that wild volatility throughout 22 in long-term rates. Anybody that has a bond portfolio and they were taking a lot of interest rate risk knows that it was painful. It was, if this bear market in the stock market was normal, the bear market in the bond market was abnormal. That was a 1 in 100-year event. But that seems to have normalized. So now we have some more stable interest rates, 10-year interest rates, longer term interest rates. Yield curve still inverted with kind of, more advantages towards the short term of the short part of the curve. But this normalization, this less volatility, this has been very supportive of the stocks. And I don't think it's a coincidence that you see as that 10-year treasury line, that blue line, starts to stabilize. That's when we started to see the eruption in the S&P 500. So what did we do to set up for this recovery? Like I mentioned, we had a barbell. It's a barbell is an interesting concept where you're really positioning for two completely opposite things, right? In this case, we wanted to be positioned for what if the market didn't realize that inflation wasn't going to last? And then on the other side is, well, when the market does realize that inflation is not going to last, the market's going to recover. So we needed to be setting up for recovery at the same time as we were limiting pain. So we had two different markets again. The NASDAQ is the part of the market that we wanted to focus on for recovery. And why is that? Well, the logic was fairly simple. The NASDAQ, or the mega cap growth ETF that we've been in, is highly concentrated in the best companies. It's that simple. And we thought that the best companies weren't crazily priced a year and a half ago when we started wading into them. We thought that they were going to be the first ones to come out of any kind of bear market. And, it's not to say that it was an easy 2022, but it was certainly the right logic, as they have been the names that have led us, out of the bear market. So, on the red side, these are the fixed income positions that benefited from the falling CPI. These are intermediate investment grade bonds for the most part, except for the emerging markets. The emerging markets we expect to kind of have an exaggerated correlation to the 10-year treasury, maybe about 1.5 times the movement. But we also expect that to benefit as the very strong dollar starts to fall versus the rest of the world, which we think will happen as interest rates start to fall relative to the rest of the world. So you can see that this whole chart's kind of reversed a little bit, right? As inflation's fallen, we've extended our duration a little bit. We're not quite back to that 4/4 number as we were pre-pandemic. And I think there's good reason for that. It's because we still want to be focused on the front end of the yield curve, because that's where you're getting the most value for the least incremental risk. On the equity side, we wanted to be in the NASDAQ 100, the mega cap growth. I mentioned that. This quarter, we're adding more small cap and high dividend. And I'll get into why in the next section. But just, keep that in the back of your mind, that is something that we're going to address going into Q3 here to try to further take advantage of this falling CPI. So target beta, I mentioned before that beta is a measure of relative volatility. As inflation was high, we wanted to lower the target beta. And now that that's all reversing, we want to increase it a little bit. So that's why, we've seen this little bit of an increase here. Let's talk about the Q3 allocation. So I'm going to address a couple of things. We're going to talk about treasury rates, which is going to inform the NASDAQ. And we're also going to talk about small cap valuations versus large cap and high dividend stocks inside the S&P 500. So I mentioned before why we aren't all the way up to that 4+ in duration. And part of the reason is this chart. This is really the only reason. The yield curve is still giving you more return for taking less interest rate risk. So there's not a huge incentive to take a lot of interest rate risk right now, even if we are lagging in slightly. If we see this yield curve start to rise where it's either flat or steepening, well, then there might be significantly more interest in the longer end of the curve. But right now, you're just not getting paid for it. It doesn't make a whole lot of sense. So let's talk about longer-term treasury rates, though. Is at risk of talking out of both sides of my mouth, there are some leading indicators, and these are two different ones. One is global PMI backlogs, which is an indicator of what the economy is going to do going forward. and one is just a sentiment survey, a ZEW survey. They're both fairly well correlated with the 10-year government bond, and they're both suggesting that the 10-year government bond's too high. Historically, the real yield right now in a 10-year government bond is about 170 basis points, which is about 40 or 50 basis points higher than, the long-term, very long-term norm. And that would suggest, some economists would say that it could be still 20 basis points too low. But I think in general, at worst, the 10-year treasury at 3.9% is fairly priced. I think there's good reason to believe that it could fall. So what does this mean? This means two things. One, at worst, I expect stable rates, right? I don't expect to see the 10-year treasury go to 5% in the next 3 to 6 months. That would be very surprising. So that should mean that you'd still want to be kind of allocated towards risk assets. Maybe you don't want a full allocation to the NASDAQ like we've had before, and you want to diversify away a little bit to some other part of the market that has had some opportunity. But it might mean that also that you want some allocation to those longer term rates. So, I mentioned that we were increasing our duration, but we don't want to get all the way back there. But we're not at 2 anymore. We're not at 4. We're at 2.5 to 3. And that's just kind of the negotiation between the expected treasury rates, where we expect treasury rates to go versus where we're getting paid. I mentioned that we had emerging market bonds. They're relatively cheap. That's what this chart's telling you, by about 1 standard deviation, which can be a fairly good return for this asset class. This is yielding closer to 7%. On a more recent, estimate, which means that, if that comes down to, 1.5 times the treasury, there's opportunity for, 7 to 12% returns in the next 12 months. I'm certainly not guaranteeing that, of course, but, that's the kind of thing that we're expecting here. It's already done 5+% year to date. Now, I mentioned that we want to move into small caps, and this chart's, a good example of why we're very interested in that. We all know that there's been this very big rally in the large cap growth stocks, which we've been appreciative of because we've all benefited. All our clients have benefited from this. But now, those stocks are looking relatively stretched versus the small cap stocks. Small cap stocks are typically more cyclical, right? They're typically more dependent on debt, and that makes changes in interest rates a much bigger deal for them. So as interest rates were rising, we didn't want to be too involved in small cap. But now with interest rates being stable, it looks like this valuation gap looks a lot more enticing today than it had been for the last year and a half. So we will be selling some large cap stock and buying small cap stocks with it. In addition to that, we think there's a great opportunity in some dividend-oriented stocks. So when I say this, I specifically mean the S&P 500 equal-weighted dividend ETF, and that's what this slide is representing. This has a forecasted dividend yield of close to 6%. That's great. We don't typically invest in dividend stocks per se. We're a total return focused organization, but when we're getting yields that are this high, that's one big portion of total return, and it starts to become a little too enticing to ignore it. That's for sure, especially when the non-dividend paying stocks have already blessed us this year. So the takeaways: market's done very well in 2023. I think a lot of it was recovery from the inflation anxiety or the inflation mania that we had in 2022. Inflation certainly peaked a year ago in June. The subsequent break led to an unusual situation where we needed to be defensive and aggressive at the same time with that barbell portfolio. And I hope that was clear, because I think some people want us to be on one side of the boat all the time or another side of the boat all the time, and that wasn't our approach over the last couple of years, because we don't time the market, and we needed to be positioned for both these polar opposite types of events. Following the recent rally, we think there's more value in small cap and dividends. We're going to generally stay in the same bond positioning with incrementally larger positions in emerging market bonds and investment grade intermediate stuff, particularly treasury bonds. A couple other things that I wanted to mention before we get to questions. I'm sure people are wondering, where's the recession conversation? I thought it was aggressive when people in financial media seemed to be convinced that it was a recession was inevitable. And now I want to caution at the same time that I don't think a recession is completely off the table either. I don't really believe in these polarized narratives, as you probably know if you've listened to me enough. And I think this is something that can certainly still happen in the next 12 months, and it's something that we need to be vigilant about. A few big things that I worry about is kind of middle market companies, small private companies between $50 and $100 million in revenue, if you will, that finance their companies, particularly in bank loans. I worry about them struggling with the rapid increase in interest rates that we've seen over the last 18 months. I worry about regional banks still, and particularly because I think a lot of them have office debt, office management debt on their balance sheets. I've looked at more than one that has a significant portion of it in commercial real estate, but particularly the office space, which is going to be in a slow-moving recession for probably a long time. And the reason for that is the debt doesn't always come due at once. It can be restructured over time. It can be sold to private credit shops. There's a lot of ways that this could be worked out. But I think it's very unclear on where that's going to go right now. And if it does cause further stress in the banking sector, I think you could see a further contraction of credit, which should be interesting. Now, finally, with the unemployment rate this low, I think it's great that we see more people coming into the labor force. But eventually that's going to end. Eventually we're going to hit our peak of the amount of people that come into the labor force. And when you're at that point, a stiff breeze can put us in recession. And it might be a small recession, it might be a technical recession. But the reason for that is you're not going to get more growth from additional labor. And it looks like we found some, like I mentioned, labor came out of the woodwork, which is great. But even the woodwork's going to run out of people at some point. So, I think that's something to consider. Now, finally, I just wanted to make one point on the individual stock portfolio in case you're invested there. I am well aware that we own one stock that has taken a dramatic spill recently. It is a small cap stock. It's called Silk Road. So Silk Road does a therapy called TCAR. It's for folks that are highly likely to have strokes. They've been growing very rapidly. Revenue's been increasing 40% a year for a few years now. It's been doing very well as a company, not necessarily as a stock price. And there's 3 treatments. There's 2 treatments that are non-invasive. There's 1 treatment that's invasive. The invasive treatment is obviously more dangerous. You don't necessarily want to do it, but it's more effective. This is one of the less invasive options. And the other non-invasive option was approved for Medicare. So, it's got some more competition. I am waiting to hear from management about how this will affect their forecast. This wasn't new news. They should have expected it. I suspect they do because I actually have a lot of confidence in this management team. So they report in early August, and we'll assess the company from there. I think it's probably just as likely as not as I sell as I buy. I double down on it. So that's all I had, Chris. Thanks.
All right, well, some great stuff. And we have time for some questions. And I do see one question has been posted to the Q&A area. If you have a question, feel free to jot it into the Q&A section of the webinar. Otherwise, you could raise your hand if you want to ask a question verbally as well. And for people watching by way of webinar subsequent, later on, feel free to reach out to us with an email if you have a question. You can send that probably the easiest way would just send it to radio@amrfinancial.com, and that'll get our attention as well. And with this, Brian, the question that Glenn asks is the ISM index still falling, and what does that imply for recession?
Yeah, I wouldn't pay too much attention to the ISM index. It's it's basically they call people up on the phone and say, what do you think is going to happen? And it's shown to be really unreliable. It's shown to have a lot of recency bias. I think your question is, are forward indicators generally still pointing to recession? The answer is yes. That there are a lot of forward indicators that stress that a recession could happen. The reality is, though, that's been the case for a year and a half. So I think people have thrown up their hands and said, hey, look, in Q2, we're expecting positive GDP. In Q1, we're expecting positive GDP, or we had positive GDP. It didn't happen in all of 2022. Earnings in the stock market are looking good for 2024. Where's the recession? How's it going to hit? And I think the real answer is that it's really hard to have a recession without credit issues when employment's strong. Hiring's been strong, and that's been the case for a year and a half. Now, like I mentioned at the end there, hiring will hit a natural top, unless we have like massive immigration in the country, it's going to hit a natural top, and then we'll be more susceptible. And it's very possible, that we could have credit issues too. And it's very possible that, a change in the unemployment could lead to credit issues. So, yeah, I absolutely don't take recession off the table. I'm not one of those people. But like I've been saying for a while now, I never thought a recession necessarily meant a crash in the stock market, because, interest rates are a very powerful force, and they would likely fall in the event of a recession.
Brian, I appreciated the direction of things. You made it clear that we intentionally had an overweight in large cap growth, with the expectation that in the rebound these positions would fare well as they have. You've indicated that there's reason to be more attracted in the current setting toward smaller or mid-cap size companies, some value or dividend paying companies. There's been a lot of commentary also about international stocks being potentially attractively priced. And that's not been a choice that we've put into this quarter's plan to enhance our international exposure. Would you speak to that a little bit, just to give any thoughts around international?
Sure. So I think you said it right there, and I just want to make sure I clarify so people understand. Our portfolios have international exposure. We have a fund, the ticker is FIIIX. It's a Fidelity Advisor International Growth Fund. And it's it's like 7% of the 50/50 portfolio, scaled down for 30/70 and scaled up for 65/35, 85/15. So it has exposure to the tune 15% of the portfolio is in this
the equity exposure. Yeah,
we changed that. When was it, Chris? Summer of last year, or fall of last year, from a fund, from an American funds fund. And that's been a very, very good move. This fund for the last year is up almost 16%. The American Euro Pacific Growth Fund has not kept pace with it over that time. So, this is one of the things that we do as part of the active allocation, is we want to make sure we're in the right funds for the right reasons at the right time. And, I'm very happy with that performance. We plan on keeping it around where we are for two reasons, right? So if you look at the ACWI index, it's like 35-40% international stock. A big part of that's China. Our fund doesn't really have much China at all. And that's purposeful. We don't think that there is a lot of guarantee that you'll get your capital out from Chinese stocks, I think is the biggest issue in my mind. Secondly, we're in a growth fund because we want to take additional volatility there. So our 7% position might act like a 10% position. And finally, we do have the emerging markets debt exposure. It's not equity, but it's debt. So it does give us more exposure to the international markets. And I think that there is a better risk reward there.
I think that's the bottom line, that you hit it right at the end, that it's a question of relative to other alternatives, and it seems like your inclination right now is to say there's more opportunity with some of these other choices than trying to overweight further our exposure in international. Thank you. You also, I appreciated your comments as it related to the potential risks of interest rates that have risen. And not only with the banks, but, business generally. There is some speculation as to whether or not the Fed will continue to raise rates. Do you have any thoughts as to that? I mean, it seems to me that there may not be a lot of reason for us to want interest rates to continue to rise, where it seems like inflation is starting to respond to, as you pointed out in the presentation. Anyway, do you have any thoughts as it relates to interest rates going forward?
Sure. So there's what I expect to happen and what I think should happen. I think those are two completely different conversations. I mean, what I think should happen is the Fed shouldn't raise interest rates. I think the more they raise at this point, the more likely they're going to have to cut in the future. And if they really just want to stay higher for longer, they should stay put. That's what I think should happen. What do I think is going to happen? Well, today happens to be a Fed day. It's the overwhelming consensus, and I have no reason to disagree with them that they're going to raise yet another 25 basis points. And, I think a fair question is, will it matter right now until the next, Fed meeting? And my position is probably not. So 25 basis points on top of 525 basis points, it's not going to move the needle too much, especially when long-term bonds just aren't responding to the Federal Reserve anymore. In fact, there's a good possibility that the expected longer-term inflation will go down further, which would put downward pressure on longer-term interest rates, which I think, probably have a bigger impact on the economy than short-term interest rates. But short-term interest rates, they can certainly have a big effect on, credit card rates are based on that. Bank loans are based on that. So, I'm really basing this on really the mortgage market's mostly keyed off of long-term interest rates.
Well, I have to say, I'm impressed how quickly you got through a lot of content there, Brian. Thanks for going through all that. And for our attendees, I want to thank you for taking the time and being with us throughout the program. If you have questions as it relates to your own portfolio, whether we have the right risk structure or design, or if you have questions about your financial plan, your cash flow needs or whatever it might be, please do reach out to us at Asset Management Resources. We're here to be of service to you. So we'd love to hear from you when you have priorities that are on your mind. Reach out to us either by phone at 508-771-8900. It's toll free if you prefer, 866-771-8901, or through our website, amrfinancial.com. Again, the webinar will be posted shortly to both the website and the YouTube channel. So Brian, thanks. Great job.
Thank you.
Thanks, everybody. We'll be in touch.